Imagine this. Over half of Americans are glued to their phones, hoping their stocks will finally make them rich enough to buy extra guac at Chipotle. And the S&P 500? It's been climbing faster than your uncle at a wedding when they announce free cake, so you'd think everyone's rolling in cash and popping confetti cannons, right? Well, here's the plot twist. Most folks aren't getting rich. Not even close. In fact, a lot of people are just high-fiving themselves for breaking even. Hey, at least it's not a loss, right? Alright, let's spill the beans on a Wall Street secret that's juicier than grandma's gossip. So, Wall Street has a pet name for most Americans. And no, it's not future millionaires. They call them capital donors, because, brace yourself, 75% of regular folks end up donating their money to the stock market like it's a charity drive. And guess who's popping champagne with your cash? Yep, the rich, living their best lives thanks to your generosity. Picture this. The top 10% of Americans are basically sitting on almost 90% of the entire stock market, like a dragon hoarding gold, but with more spreadsheets. Meanwhile, the rest of us are out here budgeting, coupon clipping, and hoping our online banking app doesn't judge us. So yeah, there's a Grand Canyon-sized gap between how regular folks invest and how the rich do it, with their private jets and investment screens that look like NASA control panels. Buckle up, because today we're pulling back the velvet curtain on how the rich really invest in stocks. No monocle required. We'll start with the basics and work our way up to the Billionaire playbook. Welcome to Finance Mindset, where financial stories are bigger than your uncle's fishtails and ambitions are so huge they need their own zip code. Alright, let's kick things off. By peeking at how regular folks invest in stocks, no secret handshakes, just real talk. Because to crack the code of why the wealthiest 10% are basically the Avengers of investing, you've got to see how investing looks at every level, whether you're rolling in dough or just rolling coins. Alright, let's talk about us regular folks. Yep, the ones who think buying stocks is as easy as ordering pizza. Spoiler alert, about 75% of retail investors end up losing money. Ouch! Why? Because we all secretly believe we're the next Wall Street genius. Move over, Warren Buffett, here comes Dave from accounting. So we pick stocks, time trades, and chase trends, usually based on expert advice from that one guy on Reddit, who also thinks Dogecoin is going to the moon. Reality check, it almost never works out. Picking stocks? Oh sure, just like picking the winning lottery numbers. Most of us end up buying high, right when everyone's throwing a party. And just when things get spicy, we panic and sell low like a clearance sale on our own money. That's why Wall Street bros lovingly call regular folks capital donors. Ouch, right? Let's be honest, most people trying to get rich quick just end up making Wall Street pros richer. It's like a charity, but with more stress and less tax deduction. But hey, not everyone's out here donating to the broke investor fund. Most folks treat investing like Vegas, except the drinks aren't free and the house always wins. But believe it or not, there are regular people who actually build real wealth in the stock market, without needing a lucky rabbit's foot. And that's where our adventure begins. Grab your metaphorical hiking boots. We're going on an investment journey. We'll start with the basics, no secret handshakes required, and work our way up to the ultra-rich's playbook. Ready? Let's make your money work harder than you do. Most people kick off their investing adventure with blue-chip stocks. You know, the Apples and Microsofts, basically the cool kids of Wall Street who always get picked first for dodgeball. Then there's Coca-Cola, the company that's probably in your fridge right now and on every continent except maybe Antarctica, unless penguins are secretly trading stocks. These giants have survived everything the market's thrown at them. Crashes, booms, and probably a few bad hair days. Not the flashiest, but hey, they're the reliable friend who always shows up with snacks. The strategy here is so simple. Even your pet goldfish could do it. Instead of frantically buying and selling like you're chasing the last slice of pizza, you just let your money chill in companies that keep growing, raking in profits and collecting dividends year after year, like getting paid for napping. Just buy, hold, and let your money do the heavy lifting, while you binge watch your favorite shows. Okay, picture this. You put all your eggs in one basket, then you trip. Scrambled portfolio, anyone? Seriously though, if you dump all your cash into just one company, even if it's shinier than your grandma's silverware, you're basically playing financial Jenga. If that company flops, gets caught in a scandal, or just decides to nap while the market runs a marathon, your portfolio faceplants right along with it. That's why smart investors say, why bet everything on Apple when you can have a whole fruit salad of tech stocks? Diversify and keep your eggs, and your money, sunny side up. Alright, let's talk about the superheroes of investing. Index funds and ETFs. Capes not included. These bad boys let you invest like a millionaire without needing a monocle or a top hat. You're basically buying teeny tiny slices of hundreds, sometimes thousands of companies. It's like a financial buffet, but you don't have to unbutton your pants after. Most folks get their first taste of index funds and ETFs through their 401k or Roth IRA, kind of like sneaking veggies into a kid's dinner. And the best part? You get those sweet, sweet tax advantages. It's like the government giving you a high five for being smart with your money. Okay, here's the part you've been waiting for. Cue the confetti cannons. Just like blue chip stocks, you don't need a PhD in rocket science or a secret handshake to get started. The strategy? Buy, hold, and let your money do the heavy lifting, while you binge watch your favorite shows. Seriously, it's that easy. And the best part? Historically, it's been high reward, like treat yourself to extra guac kind of reward. This is one of the rare investing strategies that actually works for regular folks. No magic wands required. Not just in theory, but in real life. Yes, even for people who still forget their Netflix password. Now, even with index funds doing a lot of the heavy lifting like a bodybuilder at the gym, some regular investors still take things one step further. They're like the overachievers of the financial world. They start thinking about how their money is spread out like butter on toast. And that is where diversification comes in. It's like having a buffet instead of just one dish. So instead of putting everything into a single stock or even just one type of fund, they spread it around like a financial DJ mixing tracks. Why put all your eggs in one basket? Unless you're an omelet enthusiast. Most folks like to sprinkle their investments across different sectors and regions just to keep things spicy. A dash of domestic stocks, a pinch of international ones, maybe a couple of bonds for that grown-up flavor, and if you're feeling extra fancy, toss in a real estate investment trust. Voila, a portfolio even your grandma would brag about. The goal here isn't to become the next Wolf of Wall Street. Relax. No need to buy a yacht just yet. Nope, it's all about making sure you don't put all your eggs in one basket, unless you really like omelets. Because if tech stocks take a nosedive, maybe healthcare stocks are just chilling, sipping coffee, and minding their own business. If the US market trips and falls, international markets might just do a little victory dance and keep things moving. Imagine your investments are on a roller coaster. Except thanks to diversification, you're not screaming for dear life. You're sipping a latte and scrolling memes. Diversification keeps things chill. It's like the financial version of wearing sweatpants. Simple, comfy, and always in style. Blue chip stocks, index funds, ETFs. Think of them as the Avengers of your portfolio. And for most of us mere mortals, diversification is where the magic happens. It works, no wizard hat required. Ever wonder why the top 10% of Americans basically own the stock market? Spoiler alert, it's not just because they have fancier cars and bigger swimming pools. Nope, their strategies are like investing on hard mode, with cheat codes. So, grab your monocle and let's sneak a peek at how millionaires play the stock market game. Here's a plot twist. The first move millionaires make is the same one that causes most regular folks to lose money. Yep, they pick individual stocks. Shocking, right? But here's the kicker. They're not chasing the latest meme stock on social media or trying to trade their way to a Lambo before lunch. Sorry, no get-rich-quick TikTok dances here. Millionaires do it with strategy. They hunt for companies like a truffle pig sniffs out the good stuff, carefully, and with a plan. These folks aren't just throwing darts at a stock chart and hoping for the best. Nope, they're hunting for stocks that are undervalued, or ready to blast off like a rocket strapped to a cheetah. Or maybe they just want those sweet, sweet dividends rolling in, like getting paid to own a piece of the action. Some channel their inner Warren Buffett minus the billion-dollar bank account. Others, they're on a quest to find the next Amazon, before it's cool. Hipster investors, anyone? But one thing's for sure, they're not just buying whatever Reddit says is going to the moon. They're doing their homework, no cheat codes allowed. Picture this, they're squinting at earnings reports like they're deciphering ancient treasure maps. It's basically stock picking, but with less guesswork and more serious face competitions. But here's the plot twist, okay? Even the pros can't predict the future unless they have a crystal ball, and trust me, those are always out of stock. That's why millionaires aren't just out there trying to make it rain. They're also pros at playing financial defense. Think of them as the goalkeepers of their own money. Alright, time to talk about derivatives and hedging. Basically, the financial world's version of bubble wrap for your money. And who better to show us how it's done than Mark Cuban? Yes, the guy who yells on Shark Tank. Flashback to 1999. Mark sells his company to Yahoo, probably does a happy dance, and suddenly finds himself with $1 billion in Yahoo stock. Talk about a you've got mail moment. Mark Cuban looked at the dot-com boom and thought, this party's fun, but someone's about to spill the punch. So he whipped out his secret weapon, an options caller. No, it's not a superhero, but it might as well be. Step 1. Buy a put option. It's like insurance for your stocks, except way cooler and with more confusing paperwork. Imagine having a magic ticket that lets you sell your Yahoo stock at a set price, no matter if the market throws a tantrum. Even if the stock dives faster than your phone battery on TikTok, you still get to cash out at the price on your golden ticket. And to help pay for that magic, he sold a call option, basically renting out his stock like an Airbnb for Wall Street. So, Cuban basically handed someone a golden ticket to buy his Yahoo stock at a set price, even if the stock shot up faster than a rocket fueled by Red Bull. Yep, Cuban gave up the chance to make I'm buying a yacht money if Yahoo went to the moon. But hey, in return, he made sure he wouldn't lose a dime if things went south. Now that's what I call a win-win, or at least a not-lose strategy. When the dot bubble burst and Yahoo stock took a nosedive, he didn't lose a penny. Why? Because he had a crystal ball. Just kidding, he planned ahead. Ever wonder how millionaire investors sleep at night? Spoiler alert, it's not on a bed of money. They use strategies to keep their money safer, just like Mark Cuban does. Because who wants to lose $1 billion, right? Sometimes it's to protect their overall portfolio in case the market decides to throw a tantrum. And hey, you can even earn a little extra by agreeing to sell a stock later. It's like getting paid to procrastinate, not lose our shirts strategies. But hey, not everyone's here to play it safe. Some folks want to wear two shirts and risk both. Some investors actually get a thrill from risk, like riding a roller coaster, but with more spreadsheets. That's where margin and leverage come in. Think of them as financial power tools. Just, don't lose a finger. Here's how it works. Buckle up. Picture this. You want to dive into the world of investing. You've got $1,000, but you decide to borrow another 1,000. Why not, right? Now you're rolling with $2,000 in the market. Feeling like a big shot yet? If your investment goes up, you're almost doubling your money. Just remember, you gotta pay back that loan with a little interest. But if it tanks, well, you might be crying in your cereal because you'll lose more than double. Ouch! High risk, high reward, kind of like betting your lunch money on a roulette wheel. This strategy isn't for everyone, unless you enjoy a little adrenaline with your investments. But hey, when you use borrowed money, you might just turbocharge your wealth, or your stress levels. Let's be real, most wealthy investors are busier than a squirrel at a nut convention, juggling businesses, managing teams, or just trying to keep their money mountain growing. Who has time to stare at stock tickers all day? And let's face it, index funds? Please, that's like bringing a salad to a pizza party. So instead, they toss their cash into a hedge fund, because apparently, hedge is fancier than garden. Now, a hedge fund is basically a private investment club for people who think monopoly money is too basic. It's run by pros who use investing strategies so advanced, you'd need a secret decoder ring just to keep up. And these folks are out to make money whether the market's doing the cha-cha up or the limbo down. In other words, they don't just wait for the sun to shine, they bring their own weather machine. Hedge funds come in all shapes and sizes, kind of like socks but with more zeros at the end. Some love to buy and short stocks. Think of it as the financial world's version of will it blend? Others chase after wild events like mergers, bankruptcies, or regulation changes. Basically, they're the adrenaline junkies of Wall Street. And the biggest hedge fund of them all? Bridgewater Associates, founded by Ray Dalio. He's basically the Yoda of hedge funds, minus the green skin. Bridgewater loves making big bets on global trends like predicting how China's interest rates might give oil prices a wild ride, or how US inflation could make European corporate earnings do the cha-cha. They see the whole dance floor, not just the stock tickets. Buckle up because there's one hedge fund category that's wilder than a Wall Street wolf on espresso: quantitative trading. These firms don't care about hot tips or dramatic news anchors. Nope, they let the computers do the thinking, while humans just try not to spill coffee on the keyboards. It's all about math, code, and enough data to make your laptop cry for mercy. Meet Renaissance Technologies, basically Hogwarts for math nerds, founded by ex-math whiz Jim Simons. These folks use algorithmic models to pull off more trades in a day than most of us make decisions about snacks. The rich? Oh, they're like detectives with magnifying glasses hunting for the tiniest inefficiencies, price wiggles, volume hiccups, volatility burps. Basically, patterns so sneaky, most of us wouldn't spot them if they danced the Macarena on our screens. Then, bam! Their trusty algorithms swoop in, buying and selling stocks faster than you can say Wall Street wizard. Picture this. A super nerdy quant algorithm, probably wearing digital glasses, spots a tech stock jumping up by more than 1.5%. But wait, it knows the secret. By the afternoon, that stock usually takes a little nap and dips. So what does our algorithm do? It puts on its superhero cape and shorts the stock for a few hours. Then, as soon as the pattern plays out, it makes a dramatic exit, like a ninja vanishing in a puff of trading smoke. Imagine an algorithm with a weather obsession, spotting when satellite images show Midwest rainfall dropping by 2%. It's basically the world's nerdiest weatherman. Suddenly fertilizer companies explode, well, not literally, on the stock market just a week later. Talk about a growth spurt, so the algorithm sifts through satellite data, hunting for that aha moment before anyone else. It's like, Where's Waldo, but with crops. And no, there's not some guy in an office chair squinting at the Wall Street Journal, unless he's just looking for the crossword. Nope, it's not a bunch of Wall Street wizards pulling all-nighters. It's an army of machines working 24/7, probably fueled by more electricity than my coffee habit. These supercomputers make split-second decisions faster than you can say, buy low, sell high, all thanks to math, probability, and a sprinkle of digital magic. And the returns? For some funds, like Renaissance's Medallion Fund, the numbers are so good you'd think they hacked the Matrix. We're talking 66% annual returns before fees, enough to make your piggy bank do a happy dance. Imagine a hedge fund so good, even your millionaire neighbor can't sneak in, Unless he's wearing an invisibility cloak. Seriously, this place is more exclusive than a secret society for people who only eat gold-plated caviar. By now, you've probably spotted the pattern, like a Where's Waldo for rich people. The more cash you've got, the fancier your financial wizardry becomes. It's like leveling up in a video game, except instead of a magic sword, you get a team of math geniuses and a really confusing spreadsheet. When you're a millionaire, hedge funds are like the VIP lounge of investing, complete with secret handshakes and coffee stronger than your Wi-Fi signal. Here, teams of analysts, physicists, and engineers crunch numbers on models so complex even NASA would say, "Whoa, that's a bit much." Even hedge funds have their kryptonite. At the end of the day, the fund calls the shots. You're just along for the ride, like a passenger in a limo you don't own. They decide the risk. You just get to nervously check your phone. And yes, they even tell you how much you can invest. No, you can't just Venmo them extra cash. Sure, you could hop to another hedge fund, but guess what? They're not doing your taxes. TurboTax still awaits. And they're definitely not building your estate plan. Unless you want your legacy to be a shoebox full of receipts. Optimizing your portfolio for long-term family wealth? Not unless your family is named hedge fund. So at a certain point, even hedge funds just don't cut the mustard. And now, the secret weapon of the super rich, the family office. This is how billionaires play the stock market like a game of Monopoly. Think of a family office as a private wealth empire, complete with its own castle. It's a full-time team of money wizards, analysts, tax magicians, estate ninjas, and legal eagles, all working tirelessly for one lucky individual or family. Picture this, you in a fancy chair, running your own personal hedge fund, private equity firm, and a tax-saving machine, all under one ridiculously luxurious roof. It's like having a team of financial wizards playing the market for you while you sip your latte. That, my friend, is what the rich call a family office. It's like a hedge fund, but with extra secret levels. Think of it as the financial world's ultimate cheat code. Alright, time to peek behind the velvet rope and see how billionaires really play the money game. First up, private equity. Think of it as the VIP section of investing, where the drinks are fancier and the deals are even fancier. Here, you're not just buying stocks. You're buying slices of private companies, startups, or sometimes the whole cake. All before these companies hit the public stock market. Because why wait in line when you can get in before the doors even open? Alright, time to put on your lucky socks. Because you're making a bet. You're basically hoping this company grows faster than your houseplants. No pressure. If it works, you can keep the profits and brag at family dinners, or sell it later, and finally afford that gold-plated hot tub. But if you want to go full billionaire mode, just wait until it goes public, then you can say, "I knew them before they were cool." Billionaires do this all the time. It's like their version of a hobby. Take Jeff Bezos, for example. He probably has a secret room just for counting his investments. He invested in Google back in 1998. Talk about having a crystal ball. Peter Thiel turned a $500,000 bet on Facebook into over $1 billion. That's like winning the lottery, but with more spreadsheets. Even Elon Musk got in on Stripe long before it went public. He probably has a time machine or something. Here's the catch. These deals are locked up tighter than your grandma's secret cookie recipe. You'll need a mountain of cash and a Rolodex thicker than a New York phone book just to peek inside. But hey, if you're rich enough to have your own family office, you're basically holding the golden ticket, Willy Wonka style. Alright, buckle up. It's time for the magical world of tax loss harvesting. This is basically how billionaires play financial hide-and-seek with the IRS, and win. Imagine one of your investments is soaring like a rocket, while another is crashing harder than my diet on a weekend. Trust me, even the super rich have investments that flop. Nobody's portfolio is perfect. Most people treat their losing stocks like that one sock you refuse to throw away, hoping it magically fixes itself. But billionaires? They toss it out faster than you can say laundry day. Now, instead of crying over their sad, underperforming stock, their family office does something clever. They sell it off, officially calling it a loss. Because hey, even rich people need a reason to sigh dramatically. But here's the fun part. They use that loss to magically erase the taxes on their winning investments. It's like financial wizardry, but with more spreadsheets and less Hogwarts. Ah, tax season, the time of year when you realize the government wants a slice of your investment pie. But what if you could keep a bigger piece for yourself? Enter tax loss harvesting. It's like using your losing stocks to tell Uncle Sam, "Not today, buddy." Do it right, like those clever family offices, and you'll send less cash to the taxman and more back into your investments. Now that's what I call a win-win. Okay, buckle up for this one. It might sound like a meme, but trust me, it's the real deal. Billionaires are all about the buy, borrow, die strategy. Yep, you heard that right. Elon Musk is basically the Jedi Master of buy, borrow, die. Seriously, if there was a championship belt for this, he'd be wearing it to every SpaceX launch. The guy's got more Tesla shares than most of us have socks. But here's the plot twist. He's been clutching those shares tighter than a toddler with their favorite toy, since basically day one. If he sold those shares, the taxman would show up faster than you can say capital gains. and take a giant bite out of his fortune. So what does he do? He pulls a billionaire magic trick instead. Imagine sitting on $100 billion in Tesla shares. Does he sell? Nope. He holds on tighter than a toddler with a cookie jar. Instead, he strolls into the bank and says, "Hey, mind lending me $100 million? I'll just leave these shiny shares here as collateral. No taxes, just billionaire-level borrowing." Imagine this. He pays a teeny tiny interest rate, but suddenly, boom! He's got $100 million to play with. Want to invest more? Buy a skyscraper? Start a collection of gold-plated rubber ducks? The sky's the limit. Or hey, maybe he just uses it to fund his daily life, like buying coffee that costs more than your rent. And here's the kicker, that $100 million isn't even taxed as income. Wild, right? It's like financial magic, except the rabbit is made of cash. This is what it looks like when you're playing Monopoly. Except, with real billions and no tiny plastic hotels. Ideally, all that stock ends up helping real people and not just making your accountant do a happy dance. Because let's be honest, giving back feels way better than just getting a tax break. So yeah, go ahead, invest in stocks. But let's be real, investing isn't how people get rich. It's just how they avoid moving back in with their parents. That's the real secret. Welcome to Finance Mindset, where we turn money talk from snooze fest to party mode. We break down the psychology and strategies behind wealth, minus the boring bits. Want to level up your wallet and your wit? Smash that subscribe button, give this video a like, and drop your wildest money questions in the comments. We dare you. And hey, don't be shy. Follow us on Facebook, Instagram, and TikTok for more financial wisdom, memes, and maybe a dance move or two. There's a treasure chest of lessons waiting for you right here on the channel. No map required. That's it for today's story. Unless you want to hear my secret recipe for instant ramen investments. Just kidding. Or am I? Still hungry for more? Go binge our other videos. Your future self will thank you, and maybe buy you coffee. Until next time, stay sharp, stay focused, and remember, your finance mindset is your superpower. Now go conquer those dollars.